What's going on, everybody? JT here, and I have a fantastic guest. We've got Timothy Peterson, who's the Chief Financial Advisor over at Cane Island. Timothy Peterson is a well-known and respected, industry analyst and one of the leading experts on alternative investments. He's also a published expert on cryptocurrency investment and valuation, and authored the very popular Metcalfe's Law as the model for Bitcoin's value. I'm super excited to have this conversation with Timothy. The macro conditions of the markets are kind of gloomy. Maybe that's a little bit of an understatement, to be honest. But pleasure to have this conversation. So welcome, Tim. I appreciate you taking the time out of your day to join us.
Thank you, JT. It's definitely interesting times.
Interesting times, I think, is another understatement, to be honest.
Well, these are the times that try our souls, right? That's what the saying is.
Yeah. Absolutely, absolutely. And, my audience is very much so cryptocurrency based, but, what goes on in the cryptocurrency markets is very much so affected by the macro market. So, of course, I want to take the time to learn a little bit on your perspective on the markets and the current conditions. So if we could just start off with what is your take on the state of the markets? And is there any end in sight for, those investors that are still holding strong?
Well, let's start with the second part first. There
Sure.
is an end in sight, and in fact, I think the end in sight just sort of came into focus probably within the past few weeks. That said, that end is still a bit of ways. So my take on where we are at is that and I'll talk about the economy first and then the markets. The economy is, if it's not in a recession, I think technically it is. I think it's potato.
Right.
It's definitely heading into a full-blown recession. There are, in my view, there are three types of bear markets and three types of recessions. There are shocks, which are completely unpredictable. They're the true black swans. We had one in 1987 with the market crash. It was a computer glitchy thing. And COVID was one. You just really can't predict that there's going to be a viral outbreak. That aside, the next most common type of recession is cyclical, right? And this is the one that everybody thinks of, and they think of, especially cryptocurrency and Bitcoin people. They are educated about Fed operations, and they know about the money supply effect on the economy. And there are credit cycles, and these credit cycles run about every 3 to 5 years. They happen to overlap with the Bitcoin halving, and it's actually these credit cycles that have been contributing to Bitcoin's run up and not so much the halving. But nevertheless, that's neither here nor there. Anyway, this is not one of those cycles. This is something different. And this is what's called the deleveraging. And a deleveraging happens about every 10 years. You have too much debt. You have a shock to the system, whatever it is, or it's too much stress in the system. And you get a prolonged period of economic decline and a 10-year period of economic stagnation. Markets will go up and down. You'll have these mini bull markets and mini bear markets that last about 18 months in that 10-year period. But in 10 years, the market's going to be basically where it's at today, somewhere 4,000 S&P 500, give or take.
So you're predicting what is called a lost decade.
Right. And you can see these on the S&P 500 log scale chart that they run in 10-year cycles. And somebody who's done some really good work with this is Dr. Schiller at Yale University, who won the Nobel Prize for this particular research. And that's where we're headed. So I'm not too excited about the next bull market or the next bear market, because in terms of equities, they're probably not going to go very far for the next 10 years.
Yeah, you mentioned something at the very beginning of what you were talking about. There was an event, or something that happened about last week that might have created that end in sight, the light at the end of the tunnel, or at least not a very bright light, since you're predicting a lost decade. But could we go back to that? And what was that event?
Well, the event was that we didn't recover, and so cyclical recessions would have started their recovery by now. And the S&P 500 kept pushing new lows, and we hit new lows, and it became apparent, especially if you look at what's going on in the macroeconomy. What's changed? Nothing's changed. Okay, most of this is driven by an energy crisis. There's certainly some debt overextension on the part of governments. And nothing has changed to resolve either of those two fundamental problems. And eventually governments will figure it out that something has to change or else nothing will change. In the
Right.
meantime, we're headed lower, and the Federal Reserve will try to fight that, but there's only so much they can do.
So let's go on to that point. How much lower do you think these markets can go? I believe the S&P is at least 25, maybe 30% off its highs, if I'm not mistaken. We know the cryptocurrency markets are all on average down 70 to 90%. Nasdaq's not doing so great as well. How much lower do you think these markets could endure?
My base case is 2,700 for the S&P 500, and it's a number that I keep coming up with no matter what method I use. It's really kind of weird. I've tried completely different approaches to valuing the S&P 500 in the future, and they all wind up with somewhere between 2 and 3,000. And they all arrive there at the same point, somewhere between February and October of next year. So that's my base case scenario. My fear is that is not low enough, that there is a convergence of policies globally and in all asset classes that will have this multiplier effect. So we're not just raising interest rates in the United States. They're doing it in Europe. They're doing it in South America. They're doing it in Australia. They're doing, it's everywhere. And it affects every asset class. And the combined effects of that, the multiplicative effects of that, the interactive effects, I'm not sure are really being accounted for by either the central banks or the market. So my concern is that not only does it just go low, it continues to go low because nobody has accounted for the potential for this coordinated effort to bring everything down.
Right. Right. Yeah, and it does seem like a very coordinated effort in reality. So, on the topic of interest rates, how high do you think the Federal Reserve is going to raise their interest rates? Is there a pivot in sight? There's a lot of people talking about a pivot, but it's really hard to see a case for that.
Well, yeah, there's no case for it. I'll tell you this right now. I've spent time with the Federal Reserve Board of Governors, and I have an idea of how they think. The interesting thing here, I looked at this morning, okay? If you look at the federal funds rate, which is sort of the base rate for interbank lending, more or less, it has always been higher than the inflation rate at some point, right around the peak. And we're at 8%. The federal funds rate right now the effective rate is about 2.5.
Yep.
Okay, so it's way below, but there's more to it than that. In the past, the federal funds rate has gone up in advance of inflation. So the Federal Reserve was aware of what was happening. They saw consumption getting too high. They saw inflation creeping up, and they were ahead of it. This is not the case this time. They are behind inflation by at least a year. And you can see it on the chart. Plot year-over-year inflation, plot the federal funds rate, and you're like, wow, they completely missed it. It just totally got them by surprise, and late by surprise. So hence the need to jack up rates very quickly because they're playing catch up. I personally think they need to get up to about 5%. So we're only halfway there in terms of rate increases. There are scenarios I see where the short-term rate going to 7%. And part of that is because there are three things that you need to consider. And at Jackson Hole, Powell mentioned this, and they've alluded to this in other speeches as well. They have to raise rates to, one, bring down the actual inflation. Okay, the thing that's causing it, which is largely energy, they have to raise rates to a level where consumption declines and the inflation stops. The second thing they need to do is stop the expectation of inflation. So when people think people think inflation is going to go up, they start building that into their pricing decisions and they raise prices. It becomes a self-fulfilling prophecy. So they have to stop the expectation that inflation is going to continue, in addition to stopping the actual inflation, which means you've got to go higher than what inflation requires. And the third thing they need to do is they have to counteract the government efforts that are inflationary. Because when recessions happen and inflation happens and pain happens, governments do what they want to do. Invariably, they will bring about some sort of relief. But that relief in third world countries, let's say, comes in the form of money printing. Oh, things are too expensive? We'll print some more money for it. Only makes the problem worse, right? in Western countries, we're a little bit more savvy about that. We know that's not the solution, but you still have governments doing things like proposing tax cuts,
Right.
even tax cuts on gasoline, proposing to borrow money to push forward stimulus packages. All right, any government spending and any tax reductions, which is what both parties are about, right? Republicans cut taxes, Democrats borrow and spend. Either of those things is inflationary in this environment. So the Federal Reserve has to counter the natural tendency of government. With good intentions, they want to help, but they're actually causing more inflationary harm.
Yeah, no, that's a lot of great points that you just mentioned, and I want to harken back to the to the federal funds rate, because something I've noticed, which I actually don't fully understand, is when you look up the federal interest rate, it says it's about 3.25, but as your point states, that the effective federal funds rate, which is the ones that you look up when you type in the FED fund on TradingView or wherever you chart your charts. What accounts for the difference between the effective federal funds rate and the target rate, I suppose?
Well, you've got me there. I'd have to go back and research exactly what that is. It could be because it's been a long time since I took my banking class. First of all, the federal funds target rate, there's another rate in there called the discount window. It's the rate at which the Fed actually lends money to banks. But then there's the federal funds rate is an interbank lending rate that isn't directly governed by the Fed, but it's influenced heavily by the Fed because it's the sort of the next tier down. And usually when you talk about an effective rate, you're talking about the effects of compounding, right? There's the stated rate, and then if it compounds daily, it's a little bit higher. And most of those very short-term rates are daily compounded rates. So that's possibly a part of it as well.
Makes sense. Yeah. I mean, I was doing a little bit of research on it. I couldn't really come to a really concrete answer. But on the topic of rate hikes, one of the consequences of our rate hikes has been this extreme bull run that the dollar has been on. And it seems that everything is counter to the dollar's strength right now. So if you're in cryptos, you're in stocks, you're in equities, it doesn't really matter where you are. As long as the dollar is strong, it doesn't seem like the assets you're holding are going to be strong. So my question is, when will the dollar bull run end? Do you think that'll end before the pivot, so to speak, or do you think it'll happen at the same time, a little bit after? And then what are the effects of a strong dollar globally?
Well, you got a lot there. Let's start with
sorry about that.
Let's start with why the dollar is increasing, because that once you know why it's increasing, then you can sort of figure out the rest.
Right.
And this is my opinion. But my opinion is that there's really two reasons for the dollar's increase relative to other currencies. And the first is the fact that oil and energy are traded in dollars. Okay, so we've shut everything down with COVID. You turn it back on, all that trade starts up again. But now we've constrained, because of the Ukraine war, we've constrained supply and trade among certain countries, right? Roughly 40% of the world is on one side and 60% is on the other, give or take. And there's other things like tariffs against China, which aren't that material, but the mentality is there's dollars, and then there's the group that doesn't want to use dollars. And if you need to buy energy, whether it's natural gas or solar or wherever the source is, or food for that matter, you're probably trading in dollars. And as soon as this crisis hit, everybody said, wow, they've Russia stopped shipments of fertilizer. Russia is one of the largest suppliers of fertilizer in the world. They stopped exporting fertilizer, which means crops and food are now in jeopardy worldwide. So you've got to buy food because you may not be able to grow enough. What are you going to buy it with? Dollars. So everybody, for all the same reasons, needs dollars to buy commodities. All right. So that creates a huge demand for the dollar. When you've got interest rates going up and you have questionable market activity in other parts of the world in terms of sovereign debt or potential for sovereign debt default, potential for pension fund default, like as in the UK, you have a demand for safe assets. And as US interest rates go up, the demand for those assets goes up. Now, the exception is the 10-year bond, which everyone is dumping for cash because they need cash. right? So this is a global, the makings of a true global liquidity crisis where people just need the cash. For one is for safety and investment reasons, but the other is for international trade reasons. How high does it go? I think it has another 20 to 30% to go, maybe not 30, but maybe 20% more. It is getting pretty high, but my experience is that too high can go, too high, crazy too high, right? We see it with
Right.
Bitcoin. We saw it with .com. So anyone that when you look at the historical data and you go, well, it was high before, and so this will be the top. You can't say that. It could easily blow past the prior highs.
Yeah, that makes sense. And it really is a global phenomenon. And I'm curious actually to get your take on this. I'm curious if you even have one. The Bank of England did something very strange, about a week or two ago, and it sent the pound plunging, I think, to new lows that it had never seen before. Are you aware of what they did? Because I actually am a little bit unaware of what caused it. But if you're aware, could you fill us in a little bit, and then could we get your takes on that?
I'm not, but I can give you sort of another take on the related issue that was
Sure.
part of that, and that was the UK pension issue, which people incorrectly ascribed to all kinds of other things. So, fortunately, I know enough about. I've got 30 years in institutional management. I know quite a bit about financial institutions. When I read what happened with the UK pension fund, it was really obvious to me that they were not hedged properly. And there's a thing called duration matching, and then there's an extra level of that that's called convexity. And the math is really complicated. It's calculus, but I used to do the cash flow models for insurance company investing, so I know a little bit about it. Uh, Most of the time, let's say 95% of the time, you set up your hedges so that you cover the normal scenarios. And if it goes beyond those parameters, it goes way beyond those parameters. And this is kind of what happened in the global financial crisis with the mortgage rates, right? Um, that's what happened in the UK. They didn't have the extreme outliers hedged or priced into their hedging because they're rare occurrences, right? It might only happen 1 or 2% of the time. Well, we're in a 1 or 2% event. And they didn't have their hedges on, which triggers all kind of problems with their settlement, their cash flows, and they were going to be able to miss some of their payments and basically go insolvent because of their lack of hedging. And so the Bank of England had to step in for that reason. And I'm not sure whether that's completely related to what you're talking about, but that's an isolated case. Okay, that is not a widespread scenario. Now, it is true that this interest rate hike and the inflation hikes are so rapid that they are not priced into a lot of hedges. And so, again, that's another demand for the dollar because they need those dollars to go buy hedges, and everyone's got to buy the same ones because everything's happening the same all around the world. So there's a huge demand for liquidity and credit default swaps to hedge some of these balance sheet risks on financial institutions.
Absolutely, absolutely. And there's a bunch of different currencies. There's the Japanese yuan, is it, or the yen? I'm not, or I keep mixing up the Chinese one with the Japanese one, but I believe it's the Japanese yen. All sorts of other different currencies that have been reaching new lows off of at least when compared to the U.S. dollar. Is there any chance that any of these global currencies actually truly collapse?
Not in the sense that people think. I don't see that happening. I just don't see that happening. There's going to be some pain for certain countries. I was thinking about global currency collapse the other day, and Bitcoiners are pretty keen on this, right? They're like, hey, every fiat currency fails, and that's sort of a mischaracterization. It's really every fiat currency gets revamped at some point, and it just sort of gets repackaged and reissued. I will tell you that even if they fail, the US dollar will be the last one to fail.
Right.
So the dollar's not going down. Even if all the other ones go down, the dollar will still be there. It's a Schelling point. It's the one that everyone would turn to at the end simply because it's used. It's the biggest network and therefore has the greatest network effects. It's sort of like if all of the social media failed, Facebook would be the last one to go down because one fails, you would move to Facebook. The other one fails, you'd move to Facebook, and so on. And Facebook would be gigantic, but then if it fell, That would be the end.
Right.
Dollar is the same way.
Yeah, and it doesn't even seem for some reason that all of these central banks around the world are even in lockstep with each other. So I suppose my next question has to be, how does the world get itself out of this mess? Because of course the Federal Reserve can do, what it can do to try to help the situation in the United States, but to some degree, it only has. It doesn't have the same impact globally as it does have at home. So I'm just curious, what has to happen for the situation to turn around?
Well, the underlying cause, which is basically energy and food, have to be resolved. And those are problems for government. That's not a problem for central banks.
Right. That's the issue.
Ultimately, you have to have enough pain that governments realize we have to turn on more energy. And even though nuclear may be a solution, it takes 10 or 20 years to get a nuclear power plant up and running, right? If we said, hey, we're going to build a nuclear power plant, first of all, you're going to have 10 years of lawsuits from environmentalists and people opposed to nuclear power. You've got the legal process or the government process of getting it enough votes. Then you've probably got more lawsuits, and then eventually it can get built, okay? There's a testing phase and all that stuff. It's a very, very long process. It's not that much quicker with any other new energy source, okay? It can be somewhat quicker with alternative and clean energy like solar and wind. Hydro, you can't just go out and build a dam in a few months, and you really are limited with solar and wind to geography, right? That determines whether you can get power from those sources, just like hydro does. So you wind up back to fossil fuels. It's the only other thing left. And at some point, there has to be a capitulation on the part of government to say, we need it. We use 100 million barrels of oil a day globally, and that is not going to change. And it's not, even if you wanted it to change, when we shut down the world for COVID, we were using 80 million barrels a day globally.
Right.
So even if we turn everything off and only ship the bare minimum necessary for survival in the way of food and emergency services, we're consuming 80 million barrels a day. We have to have at least that much in production, or else the world cannot survive. It's the dark ages. And until governments realize that that's the way it is, and that's what needs to be facilitated, this economic melees will continue, and it really doesn't matter what central banks do.
Yeah, that's my fear as well, because a lot of these central banks, they just have very blunt tools, but a lot of the issues, have to be dealt with by the government, and we all know how slow the government is to act. And as somebody that does appreciate the environmentalist take on the need for renewable energy, it is also the realist take that what you said is absolutely correct. And I'm a big proponent of nuclear energy, but as you said, that's 10, 20 years out. If that, I mean, there could be hurdles in the way, like lawsuits and what have you. So really, this is a very interesting situation. So how about we close on a maybe not, I don't want to say a bright side, but just something so people can leave here with, a little bit more hope or understanding on how to navigate these tough times. So my final question is, what would you say to those either in the markets or on the sidelines of the markets that, want to enter or maybe are in and are really fearful currently? What would you say to all of those people, hoping for the light at the end of the tunnel?
Well, I would have two pieces of advice, more or less. The first is don't try to time the bottoms and the tops. I don't do that personally, and I'm a professional manager. You will almost always fail. I would much rather try to go with whatever the trend is, even if it means missing the bottom or missing the top. My goal with my portfolio is to move the ball forward, right? Every couple of years, I want to see a higher balance. If I can't get a higher balance with rate of return, that means I need to put in more money that I've earned and just add to my portfolio with a capital contribution. But either way, that number needs to go up. And if I can't get it with return, I can get it with contribution. The second thing is, there is always some best investment, always, whatever's at the top. It could even be cash. And most of my time I spend trying to figure out what's going to be the best performing investment over a certain time frame. I will tell you that right now, the equity outlook for the next 10 years may not be good, but the outlook for commodities and energy is very good. So I'm interested in, over the long term, gold, um, lithium, energy, anything related to consumption of commodities, including agriculture. That's where I'm going to focus my energy on. The recommended allocation for equities during the next 10 years is only 15%, which means 85% should probably be in something else. And people that do their investing, I assume, like to do it. And so have
Right.
fun with it. Go find your fun thing that's out there in the realm of asset class capabilities and learn about something new that you haven't invested in before, because you might really find something that you enjoy.
That's fantastic. And I did think of one last question, if you don't mind. I'm curious to get your take because we're talking about a lost decade for equities. Do you think that is going to be the same case for the crypto market? Do you think Bitcoin and maybe some of the other leading cryptocurrencies are also going to experience this lost decade, or do you think the innovation might be able to outpace that?
That's a great question. So what happens to cryptocurrency and Bitcoin in the next 10 years? And I thought about this basically about 2 years ago, at least 1 year ago. And I knew about these long-term secular cycles. And I said, you know what? We've been in a 10-year boom period, and that's where this crypto industry has grown up in. And I said, I have to consider the fact that it will be flat for 10 years. I don't like that, but it could be that way. I think there are still some good opportunities. I think Bitcoin's it's still growing at 15% a year in terms of user growth, which implies that a minimum it'll grow at 30% a year. 30% a year is a great return in an economic secular bear market. So Bitcoin, I think, has tremendous possibility for 10 years. I still see Ethereum as being useful during that time. I know some people, I don't want to get into the whole this or that with the different cryptocurrencies. I think the ones at the top of the pile now are the ones that are going to survive. I would definitely not get into speculative investments. I would stop looking for the next 10 bagger over the next 10 years. You could really get wiped out doing that. On the other hand, these are the decades where people build, right? If you look at what happened after the dot-com bust, right, all of the initial winners turned out to be nobodies. And what came out of that? People went and built on the web, and they built lasting things. And after that, starting in 2008, that's when you got YouTube, Google, Facebook, the current environment, the whole Web 2 push was built during that time. Web 3, whatever you want to call Web 3, I don't want to get into the definitions too much, but the next iteration of what the internet and monetization of that looks like is going to be built over the next decade. And when you come out of that, boy, there's some great fortunes that could be made at the end of that period.
Yeah, I couldn't agree more. I mean, over here at my channel, we focus a lot on interviewing new projects and builders that are, still building in the space during these trying times, and it's very encouraging. And I completely agree with you that out of the ashes, something great will come from it. But hopefully, we'll get there sooner than later.
Yeah, like I said, interesting times.
Absolutely. Interesting times indeed. It's come full circle. I appreciate you taking the time out of your day, Tim, to join us on this program. It's been very illuminating, and I really appreciate it. I hope everybody else in the audience does as well.
Thanks, JT.
Absolutely. Till next time. All right, everybody, that was my conversation with Timothy Peterson. I really appreciate all of you that stayed to the end of this episode, and I really hope you learned something from it. This conversation was very illuminating on Tim's perspective on the global economy and global market conditions, and I think we can all walk away saying that we learned something from it. If you did learn something or you found something of value, smash that thumbs up button and consider subscribing to the channel. It certainly helps this channel grow some more, and we're trying to get some more fantastic guests onto this show. Now, before we go, I want to let you know about some links in the description of this video. In the description, you'll find a link to Lofty AI, and Lofty AI is a real estate investment platform built on top of the Algorand blockchain. Using my link, you'll be able to get $25 towards your next real estate investment on Algorand. And this is fantastic because most investment minimums on the platform are $50. So this is essentially half of a real estate token just from using my link. And these tokens are cash flowing assets, meaning each token you hold represents your proportion of ownership in real estate, and this real estate pays rental income. So for every token you hold, you will be generating cash flow. So check out that link down below, get your $25 towards your next investment. Hit me up down in the comments, give me some suggestions, some comments, some feedback, whatever it might be. Fight amongst yourselves. Just hit me up down in the comments below, like and subscribe, get that $25, and we'll catch you in the next one. Thanks.